But so going to kind of move on to 1031 exchanges. And right now, 1031 exchanges are a great tool. Those of you that have properties more on the single family, a lot of times there's some cons with that. You have 45 days to identify your new property and 180 days to buy your replacement property. It's a great vehicle to defer taxes indefinitely, but you really have ever-changing tax rates, and taxes are deferred and not tax-free. Again, there's been some speculation that 1031s could be eliminated, and I'm not sure if everybody is aware of that. 1031s were eliminated in their entirety with the 2017 tax cuts. So think of trading in a car. Every time you traded in a vehicle and bought a new vehicle, that was a 1031 exchange. So the construction worker who traded in that work truck ultimately did a 1031. They eliminated it across the board because it created a lot of situations. People got stuck into it in a car. It wasn't a great deal. You trade in a business Mercedes for a business Porsche, and you're limited on that. It didn't result in a good situation. They did at the last minute put real estate back into it, and there's been speculation that it could be eliminated or limited with the new administration. So also for the investor that's that's not necessarily as business savvy, I would say it could result in a large gain at a time of sale with little proceeds received on leveraged properties that have had previous 1031s. So once you start doing that, it's something to be aware of the situation, I always advise. But again, it's just another planning tool to be able to look at. If you're selling a $30,000 property, it may not be as advantageous as opposed to a $1 million property. But you can also take a pool of 15 rental properties. If you structure the deal correctly, do a 1031 into 2 multifamilies down into Florida where you want to retire. So I've had clients that have sold multifamily deals into commercial properties, into properties in other states. So if it's structured correctly, it's a great way to really diversify your portfolio. So and we'll just see what future legislation brings with the new administration. So then cost segregation is another tool that comes up. Wrong slide, sorry. Cost segregation's another strategy I get quite often. And it really comes down to those of you that have your properties that you're rehabbing. Think of you're going in, doing improvements to the property. And in this case, I just found a quick example. You have a $5 million, but let's say it's a $50,000 property. That same segregation you would allocate to different buckets, such as 5-year property, 7-year, and 15-year. That and actually this would be 27.5 year on single family. But what that's going to do is really accelerate your depreciation. That passive W-2 investor, it doesn't matter what depreciation he gets if he's limited. It'll just increase his passive losses. So cost segregation becomes a big question, but I always say use it wisely. You don't need to get overwhelmed on the smaller deals because you still may be a W-2 investor, or your outside investors may be on large office buildings. Then also on a cost segregation, are you a real estate professional? If you're a real estate professional, absolutely all day long, you should be doing a cost segregation. You'll get substantial benefits. That doctor that invests in a deal that gets a cost segregation, he'll get a great passive loss. It might offset his passive income that's coming through on deals he invested 10 years ago. So it's really a situation. I have a client that does multifamily, low-income housing, and they'll buy anywhere from $5 to $10 million properties, and put a few $1 million in renovations and their large tax credit deals. Their investor is generally more on the institutional side that is investing in the deal for the tax credits and the depreciation. In their case, it's passive, but it offsets their other passive income. And they'll effectively, their renovations on the multifamily with the cost segregation take multi-million-dollar first-year deductions based on that. So it has its place, but again, a cost segregation is, and I don't think I have it in here, it's a formal report generally written by somebody with an accounting background, but also an engineering background. It's going to be, they're doing a site study, an engineering study, and looking at everything within your plan. Think of an office building. As an accountant, I can tell you the numbers, but you need an engineering background. And if you don't have the proper documentation, I can tell you it's not going to hold up under IRS audit. And there's companies you can find online for $200 that'll do them, and they're probably not worth the paper they're written on. So it's something to navigate, but at least be aware a deal may present itself. It's a great opportunity. The larger deals, more on self-storage, a lot of that material is personal property as opposed to structural buildings. So they're great opportunities. Then